Hi, and welcome to this session of Mind of the Manager. I'm Linda Eedes, and I'm joined today by two of my colleagues, Nancy Hossack and Wim Murray, who are both portfolio managers for the Foord Equity Fund, alongside Nick Balkan. And so it goes without saying, of course, that we're going to be talking today about the South African opportunity set and the outlook for the South African economy as well. At the moment, it feels like many companies are literally treading water. We've seen very slow revenue growth for many businesses, given the headwinds that they face, and incredible pressures on input costs as well. And in terms of the outlook, there's not much to get excited about when we consider the economic backdrop that we face. Add to that the political uncertainty of the elections coming up in 2024. And when you factor an interest rate cycle on top of that, it's been a really tough environment, particularly for the locally facing businesses. And so the question is, are there opportunities still to be found on the JSE? Now, most of you will be aware that Foord has both a top-down macro research-driven element to our investment process, and we also have a bottom-up valuation-driven element as well. And I think more than ever, we need to consider a lot of the macro issues on a global context, which actually factor into the South African situation. But equally important is security selection within asset classes, the types of businesses that we invest in, given the backdrop that we face. Now, Nancy is going to talk to the top-down picture, give us some context from a global perspective, and then feature that into the South African economic landscape, talking about some of the issues that we debate almost on a daily basis here in the investment team at Foord. And Wim is going to walk you through a few great examples of our bottom-up selection process, which will hopefully give you an idea together of how that fits together to actually populate our local equity portfolios. Now, it would be remiss of me not to mention the stellar performance of the Foord Equity Fund over the past few years, obviously in large part due to Nancy and Wim here, as well as Nick Balkan. Over the last year, the Foord Equity Fund, is fourth in its category out of 77 funds. It's delivered 18.5% net of fees for the year, when the average fund has delivered only slightly ahead of 11%. Over the past 3 years, it's delivered just shy of 17% per year. And we believe we continue to be in an environment that very much suits Foord's investment process. Risk management is at the heart of everything that we do. So first and foremost, we understand that protecting capital is the most important starting point to growing capital over the long term. So we need to consider the macroeconomic landscape, and we do that very comprehensively within our process. But also, we are very cognizant of the fact that we've come out of an environment globally of incredibly low interest rates and ultra-easy money, which was a tide that lifted all boats. However, we've seen a complete reversal of this. So this is an environment where security selection is absolutely critical. After Wim's section, we will be doing a Q&A, so do put your questions to us. There is a Q&A box. I'm sure you're all familiar with how that works. And I'll be checking that throughout the session, hopefully to be able to put those questions to them if we have time for all the questions. I'm sure we won't, so I do commit to you that we will get back to you with an answer after the session if you post a question in the Q&A box. And with that, I'll hand over to you, Nancy.
Thank you, Linda. And thank you, everybody, for joining us today. As Linda mentioned, I'm going to do the sort of top-down section and just give you a sense about how we're thinking about global markets, also how we're thinking about the SA market, and then I'm going to hand over to Wim, and he's just going to give you some examples of how we think about stocks from a bottom-up approach. So just starting off, I think, with global markets, and I think it makes the most sense to do that. And what we thought we'd do, I know it's a lot easier for many advisors if we kind of give our summary slide, and this is essentially our summary slide on global markets. And after this slide, I'm going to drill down into a little bit of the data and the thinking that kind of back it up. But in summary, we think that the latest rally that we've seen in the US is very typical of a bear market rally, so we're quite cautious in terms of our exposure to that market. A lot of the hype that we're seeing in the US is being driven by the AI revolution. And while we think that those are some very, very important developments, we're also quite cognizant that they're very long-dated developments. A lot of the investment cases around AI are very uncertain at this point. And we saw a very similar type of sentiment in the dot-com bubble. The online trends that we saw kind of spoken about in the dot-com bubble certainly did come to fruition, but they took a very, very long time, and actually they're both winners and losers in these types of adjustment. US earnings and labour markets are still very high in their cycle, and we think that both of those two things have further downside. But in contrast to that, China has been under a lot of pressure since COVID began, and the economy in China is still at very depressed levels, but we are starting to see some green shoots. And so, in summary, we favour Chinese equities at the moment over US equities. So, just sort of getting into the weeds and into the data, this is the S&P 500 index in real terms, so adjusted for inflation. And 2022 was a rough year. I think we all know that. Big drawdown in the market, particularly in the S&P. And what have we seen in 2023? Well, we've started to see actually a relatively material rally in that index. What's interesting to note is if we dissect this index into its constituent parts, so we take the real earnings of the S&P, and we also take the PE multiple. So you'll see the earnings are represented here in the grey line, and the rating on that index is represented in the red line. And it's interesting to note that actually in 2023, we've seen decreasing real earnings from the S&P, but a large re-rating in terms of the overall rating of the market. Now, the reason we believe that this could be a bear market rally is, I think, further evidenced by the lack of breadth on the market. And so on the left-hand side, what we're showing here is the S&P 500, excluding the big tech shares that have really driven the rally in 2023. That would be Apple, Alphabet, Amazon, Meta, Microsoft, and Nvidia. And actually, if you exclude those top six, the rest of the 494 stocks have actually been relatively flat year on year. Interestingly, if we look at breadth, it's another measure basically in terms of how wide the rally has been in the market. And essentially, this is done on the number of stocks on the S&P 500 that are above the 200-day moving average. We can see that the breadth in the current market at the moment is actually fifth quintile. So we've just emphasized that with the circle here. And typically what we see with breadth that's as poor as we're seeing right now in the S&P is that returns going forward tend to be quite weak. And so we are cautioning investors not to get caught up in this rally. Further to that point, we're just demonstrating here that earnings in the US still remain very high relative to their long-term trajectory, and so too does the tightness in the labor market. So the black line that you can see here is S&P 500 real earnings. It's essentially similar to the previous chart that we showed. And what we've overlaid there is a measure of labor market tightness. So in this case, what we've used is number of job openings in the US relative to the number of unemployed people. And you can see, naturally, they do have a very high correlation. Amazingly, in 2022, there were 2 job openings to every unemployed person in the United States. If you drove around the States, you would see help wanted signs in many, many shop and restaurant windows. A real lack of supply of labor, according to the growth that was taking place at the time. We have started to see that soften, and you can see that in both metrics, both earnings and the labor market are starting to soften, but still at very high and elevated levels relative to their history. I wanted to show this chart because it's not often that you see economic metrics at sort of multi-decade highs. And what this is showing is actually, it's the previous metric that we used in the previous slide, so labor market tightness, but it's essentially the inverse of that. So instead of job openings to unemployed people, it's unemployed people per job opening. And what you can see here is that when you look back much further, so this was data that was compiled by a Federal Reserve economist, actually the labor market in the US has never been tighter than it currently is. The only other period where we had labour market tightness that was similar to what we're currently seeing was in the 1970s, and that is a period the economic historians will know that was associated with very, very high inflation and resurging inflation. And it's the famous Volcker era where the Fed had to really increase rates very dramatically in order to get that inflation under control. So we just think it's worth bearing in mind that history and the similarities that we're currently seeing in the labour market at the moment. I'm now going to turn to the contrast that we're seeing in the Chinese market, and this is retail sales for both China and the US, and it's nominal retail sales. And this just gives a sense of where we've been, what sort of happened with COVID, and what we're essentially seeing now. So going back to the majority of the 2000s, Chinese retail sales really grew at quite a clip, very fast growth rates indeed, and the US's natural growth rate was quite far below what we saw from China. And then in 2018, we saw those Chinese retail sales start to slow. Then we saw a very negative reaction in 2020 with the COVID lockdowns coming into China. As you guys will all know, China had the most severe COVID lockdowns of probably most economies. So we saw a little blip as those base effects worked through. But actually, if you look at the last 12 to 18 months, retail sales in China have actually been negative. Very, very tough times. In contrast to that, post the original low we saw with the lockdowns in the US, we've actually seen extraordinarily high retail sales out of the US. So much of that has been from the fiscal stimulus, the checks that were handed out to consumers in the US, and actually the US consumers are still working through those cash balances. So even post the initial blip, we've still had very, very high retail sales. Having said that, we do think fortunes are changing, and you can start to see those US retail sales coming off, starting to see some of our US companies disappointing in terms of their sales, and actually Chinese retail sales are starting to recover at the same time. I mentioned that China has really had a very, very tough last 12 to 18 months. I think something that we don't fully recognize necessarily in the West is just how tough it's been in terms of their property market. And their property market is very important to the Chinese economy. So about 23% of Chinese GDP is actually driven by the property market. And this just gives a sense it's the new property starts and land sales. And you can see that both of these metrics actually bottomed out last year at down 40% year on year. As you guys might well know, many of the developers have been facing cash flow constraints. There's been a lot of knock-on effects in this industry, and the government hasn't really rushed to bail them out. So a lot of these kind of bankruptcies and restructurings are still working their way through that economy. Having said that, we're yet to see a stabilization. We are seeing the rate of change start to improve slightly from a land sales perspective. And we would expect, as you know, the next 12 to 18 months, that this market does start to stabilize. And that would obviously be supportive to the economy going forward. This is just an interesting chart because I think sometimes we also need to have a look at what monetary stimulus has taken place in the two different jurisdictions and how that's really affected financial markets. So the black line is the Fed's balance sheet relative to the balance sheet of the People's Bank of China. And you can see that from 2008, the Federal Reserve has stimulated, from a monetary policy perspective, much more than the PBOC has. And interestingly, that has really driven a substantial outperformance of the American markets over the Chinese markets. The big question is, who has room to stimulate now? And what we would caution is that America is still seeing quite high persistent inflation. We've shown you that the labor market in the US continues to be high. We know the Fed's watching that very closely. But in contrast to that, China is actually seeing very, very low inflation, and on some metrics, actually deflation. The Fed has also told us that they expect to tighten their balance sheet going forward. So we know that the rate of change for the Fed is certainly down. It's unclear to us at the moment how much stimulus the Chinese will do in their local economy, but certainly we think that this black line should start to trend down, and also then the comparative performance of the Chinese equity market over the US market. This is just another chart on the left showing the differential in performance of US and Chinese equities, and also where we think that earnings are going to be over the next 2 years. So because, as we've said, Chinese earnings are at quite depressed levels, we certainly see that forecasted growth for our Chinese companies is well in excess of what the US will deliver. So that hopefully gives you a little bit of a sense of how we're thinking about the global markets. And now I'm going to turn to South Africa to go through some of our more local macro issues. So we've titled this Treading Carefully in South Africa. And so it's really not, we think South Africa is not a kind of buy the market type of environment. We're having to be very cautious about the exposures that we have and where we specifically don't want to be. So there's been a lot written in the financial commentators in South Africa about how cheap local stocks look, and they do look cheap. But we think that there are some good reasons for this. And there are 3 primary reasons. First, we've had 15 years of stagnant growth in South Africa, and so the growth forecast that international and local investors are willing to put on our stocks has actually decreased. Number 2, and very importantly, we think there's the rising risk of a sovereign debt crisis in South Africa. And number 3, we have a huge amount of uncertainty surrounding our 2024 elections. We unfortunately also think that some of our offshore counters on the JSE are very high in their earnings cycle, similar to many of the US companies. And so we have to be quite strategic about which of these offshore companies we own. And we also think that resources have further downside to their earnings. So how are we responding? We have quite high cash balances in the Foord Equity Fund, and you'll see that towards the end of my presentation. As I mentioned, we're being highly selective on rand hedges, but also highly selective on SA Inc. companies. We're looking for certain attributes in those SA Inc. companies that we think can be resilient in terms of a lot of uncertainty and stagnant growth. And we maintain our underweight on the resource counters. So let's talk a little bit about the sovereign risks that we think are rising. And this just gives a sense of why those risks are becoming heightened. So in the red area graph below, you'll see these are the deficits that we've been running. So South Africa's been running quite considerable deficits post-2008, obviously accelerated in COVID and have reduced since then. But certainly this is causing our debt stock to rise over time. And in the grey line, you can see interest payments as a percentage of our revenue. So actually, we're on track to be hitting about 20% of our tax revenue is going to be spent on interest payments in the forecast period. It's really a lot. If you just think 20 cents of every rand that the taxpayer is paying is going to service interest. As well as the deficits that we've been running, the other problem with our spiraling interest costs is that the real returns that government bondholders are demanding has also materially increased. And so what we show here is the SA 10-year real rate, so excluding inflation, minus the US 10-year real rate. And what this really shows is that the country risk premium that investors are demanding has also escalated quite alarmingly. To reinforce that point, this is data that comes out of the bond exchange in South Africa, and it essentially shows the foreign net purchases or sales in our bond market. And since 2017, we've actually seen foreigners exiting our bond market. And as you can see from this chart, this became particularly excessive over the last 2 years. So the question that we asked ourselves is, well, if foreigners are selling our bonds, who is buying our bonds? And this is data that we've got from Treasury on the left-hand side. And what you can essentially see there is that the red bars are what they label as monetary institutions. That is essentially South African banks. So the people that have been stepping into the breach of the foreign bond sales have actually been our South African banks. Interestingly, you can see that represented in terms of their own balance sheets. So we're checking that data. And this is from the BA 900 data, the chart on the right. It shows government securities as a percentage of the bank's total assets. And you can see that almost all of our big banks in South Africa have been increasing their allocation to South African government bonds. And actually, some of our big banks are sitting at between 15 to 20% of their balance sheet in South African government bonds. So can the South African banks continue to finance our deficits going forward? We know that we're going to continue to run deficits in our forecast period. Well, we've chatted to some of those banks, and I would say they're becoming a little bit more circumspect in terms of their allocations. And there's 2 reasons for that. The first reason is that they don't want too much concentration in a single asset class to a single counterparty. That's just normal kind of risk mitigation strategy. And the second is that they also have to maintain their lending franchises to their typical customer, which is corporates and households. They can't afford that to be completely swamped out by just lending to the government. So the question is then, if banks are not able to continue to allocate their balance sheets to buying our government bonds, and in the absence of growth that could potentially bring back foreign investors, who then is the natural buyer for our bonds? Well, there's only a few people left really on this chart, and those would be pension funds, insurers, and asset managers like ourselves. And so far, we've seen those players be quite circumspect about the allocation in their portfolios towards government bonds. Actually, in recent times, we've seen many of them take advantage of the increased legislation to allow them to increase their offshore allocations rather than allocating domestically. So this is where we're starting to think about risks that could arise from this lack of ready demand for our bonds. How is the government going to respond to this? We do think that it's important to start thinking about the possibility that we could see prescribed asset regulation. And we also think it's important to start thinking about whether we might see increased political pressure on the Reserve Bank to increase the inflation targeting, to increase the inflation rate that we run in South Africa. Essentially, another way to get rid of your debt burden is to run higher inflationary rates. So those are 2 very real risks, and I'm going to say them again because I think that this is a very important point for us as asset managers to start to think about, but also for financial advisors to start to think about and to plan. We need to start thinking about higher risk of prescribed assets and also the potential for South Africa to start running a higher inflationary environment. This just shows that we still think that Treasury is quite optimistic in terms of their projections. It's actually ABSA's projections for where they think that the deficits are going to be going forward, and also where how public indebtedness will continue to rise. We think the stabilization that Treasury is looking for is still too optimistic at this stage. This is a man that really gets it, and I think that this is an important quote. So this was the conclusion of Lesseche's latest speech to the IMF. He says, with too much borrowing, not much domestic saving, and limited non-resident appetite for our assets, interest rates must rise to restore balance. The alternative is an inflationary balance of payments problem, which is plainly against the Reserve Bank's mandate. This does not make the Reserve Bank popular, but facts are facts. We have gotten ourselves back to the trap we escaped in the mid-1990s. Now, the risks that I just mentioned are also going to be heavily influenced by what we see in 2024. So because politics plays such an important role in terms of our policy and then in terms of our growth, we spend quite a lot of time at Foord looking at electoral support. We use a lot of the by-election data that we see almost weekly in South Africa, and we build this up from a provincial basis into a national kind of model, and we get a sense of where we think current electoral support is sitting. So this is what our model tells us. We think that the ANC is around 48.8% of current electoral support. The DA is sitting at around 15%, the EFF at around 14.4%, the IFP is sitting at 10%, just over 10%, actually doing very well. We think that there's actually potential for the IFP and the DA, if they go into a coalition, to actually take a majority in KwaZulu-Natal based on the latest by-election results. And then importantly, smaller parties are also growing their participation in terms of electoral support. The smaller parties combined are sitting at about 12%. So what does this mean? Well, it's entirely possible that the ANC actually does maintain a majority in 2024. 48.8 is not that far away from 50, and there's always a margin of error with all of these types of forecasts. So I think in that scenario, we would know with a high degree of certainty what we're in for, more of the same. We've lived through it for quite a long time, this kind of low to sort of stagnant growth economic outlook. If the ANC does not get a majority, that just heightens the uncertainty going forward, and then we're going into coalition politics. And there's some good outcomes within those coalition possibilities, which would be, for instance, a DA and ANC tie-up. We think that that would be quite positive from a technocratic perspective to add some technocratic ability to the state. But there's also some very real negative outcomes that will not be looked on well by capital markets, which would be, for example, an EFF and an ANC tie-up. One thing I do think that we can bank on is a lot of uncertainty going into 2024. Even if we see formal coalitions, I don't think we're going to wake up after the election and know what our future holds. As we've seen from the metros in Gauteng, even the coalition arrangements have been incredibly unstable. And a lot of the times it comes down to a fight for resources. And we've seen many repositions of these various coalitions as time has progressed. So that level of uncertainty has to feed into how we value South African assets, because, as we all know, investors don't like to pay up an environment that's tainted with uncertainty. Here's just showing the valuation differential. We really are not unwise to the fact that there's a very large valuation differential between South African stocks, and here we use the mid-cap the mid-cap index, because it's really quite a good proxy for SA Inc. companies, and that just shows you the large differential between ourselves and the US market. Many of our stocks are very cheap. And here's kind of some scenario analysis around that. So what we really did was we said, right, let's take really negative growth outcomes and then really positive growth outcomes and give us a sense of what our current stock market is pricing in. So if you look at really negative outcomes in our peer group, in Africa, for example, a really negative outcome could be a minus 3% per capita real growth outcome. To that, we add a bit of population. We do still have population growth in South Africa and a bit of inflation. And then we compare it to our top 5 holdings, and we can see many of our top 5 holdings have on average an ROE of 20%. And so if you plug that all in, you actually get a justified PE on those stocks. And I'm going to emphasize on those stocks, not on all South African stocks, of around 8.8 times. So already, many of our stocks, these are the current multiples that they're trading on, are actually pricing in quite poor economic outcomes in South Africa. Having said that, if we can pivot and get higher growth, certainly investors are going to make a lot of money from South African stocks. And then just lastly, before I hand over to Wim, this is how we are positioned in our local equity portfolio. because of the uncertainties in South Africa and because of the uncertainties as well in the global markets, we have a very high cash and gold weighting. So we're sitting at about 16% in that portfolio. And then you can see that we are slightly underweight SA Inc. It might interest you to know that the all-share index, so just the benchmark, only has about 42% of that index is actually made up by really SA Inc. counters. We have a very global index, and we are slightly underneath that. So if you buy the Foord SA Equity Fund, actually only about 37% of that portfolio is leveraged to the South African GDP. And then in contrast to that, we have an overweight in overseas companies, and we still maintain quite a big underweight in resources. In resources, we still think that we're going to get earnings downgrades. We're starting to see a lot of those downgrades come through on the back of much softer commodity prices. And I think with that, I'm going to hand over to Wim, and he's just going to take you through some of our thinking from a bottom-up approach.
Thanks, Nancy. Yeah, so Nancy has spoken a bit about the tough macros we've seen and then also what's expected going forward. But the question then is, what do we do? So within this environment, we need to find opportunities that will do well for our investors. And today we're going to talk about two ideas that are in our portfolios. The one would be more the bread and butter of what we spend most of our time trying to find. And then the other one is a more esoteric example of where, despite tough top-down metrics, we do believe on a bottom-up basis there is value to be had for investors. So this slide shows the performance for all the big banks since the start of January 2010. And the reality, of course, is that these counters and SA has faced numerous headwinds over this period. So the banks specifically are linked to GDP growth. And there we've seen the headwinds in the form of state capture. There's been Nenegate, political instability, which we all know about, and then a culmination of COVID, seeing lockdowns of total economies. And then also more recently, we've had the war in the Ukraine and Russia causing supply chain disruptions and then also spikes in inflation. So it hasn't been a great place to hide the banking sector overall. But if we then look at FirstRand, we see very material outperformance, not only of their peers, but of the JSE specifically as well. And then as an investor, it's important to understand why have they been able to do so well. So for all companies, but specifically for banks, management is critical. In the case of a bank, you have someone lending out money, and it's very important that A, you have the right person doing the lending, and B, you have the right incentives in place to make sure that it is actually good loans. And with FirstRand, we see best-in-class management. So the ownership culture that exists has existed for a long time. The senior and divisional managers are large shareholders within the business. They enjoy long tenures within their various roles, and they are allowed and incentivized to build the business for the long term. So most companies will talk to you about an entrepreneurial culture and innovation that exists, and we are highly skeptical of this in most instances. But with FirstRand, the proof is actually in the pudding, and they've been responsible for incubating companies such as Outsurance and Discovery, where they actually provided the seed funding for Willem Roos at Outsurance and Adrian Gore at Discovery to build what today is leading companies within their respective industries with valuations multiple billions of rands. So truly a case of having a long-term view and having an entrepreneurial culture where there's full accountability. And then if we look at the incentive structure, there's four factors that's important that distinguishes them from the other banks. The one is it is done on a divisional basis. So there where management's able to influence outcome, they are evaluated, and if you outperform, you are rewarded. It's very much performance-based, so the base salary is usually quite low, but you do well if you exceed expectations. And then very importantly for a bank, they are measured after taking into account both the cost of capital on a divisional basis and the cost of risk. So simply growing your loan book is not enough. The money needs to come back, and you need to create value for shareholders, of which the management are large shareholders. And all of this culminates into a high return on equity for the business. And if we look at this chart, it's incredibly telling. So on average, despite all the headwinds faced, we can see FirstRand have been able to generate an ROE in excess of 20% throughout the cycle, with the exception of the GFC in 2010 and then COVID in 2020 and the impacts thereafter in 2021. But they're now back on track, and the outlook going forward is quite attractive as well. Now, in terms of shareholding, what does this amount to? Well, the ability to deploy capital at attractive rates meaningfully adds up over time. So here we take R1 that has been retained within FirstRand, and we see the value of compounding it over time, and today it would be worth close to R4 for the business. And this is simply the retained capital within FirstRand that exists. And it's meaningfully ahead of what we would see for all the other banks. And if you were to add on top of this total returns, which would include dividends paid out, then we can see within this chart there's quite a bit of volatility. But over time, if you are able to deploy capital on high rates of return, then you get these wonderful numbers. So for a shareholder who put R1 in FirstRand at the start of 2010, despite all the headwinds we've spoken about, today they will have close to R8. And that's almost double what you would have if you had invested in the JSE specifically, and it's well ahead of what we have seen for the other banks. So just to close off on FirstRand, very much what we hope to find: good quality companies, good management, they have a good position within their various markets, and we think the outlook is attractive going forward. Now the next chart, it shows, it speaks to the property segment, which overall we are quite negative on. So the top downs of property at the moment, we believe faces multiple headwinds. But despite having a very cautious top-down view of property, we are able to find opportunities on a bottom-up basis. So if we were to look at this chart, it's one of the key risks that we believe exist in the property segment at the moment. So this would be the capitalization rates, which is used to value the underlying properties owned by the listed counters, and it compares the cap rate versus the government bond yield. And what we can see is, while the bond yields have moved up significantly in response to the risk and rising rates that we've seen in SA, the cap rates have been very slow to move. And it's important to understand why this is. So for all the listed counters, their properties are valued by independent valuers who have quite a lot of leeway in terms of how they want to go about valuing the business. So they can take the view that current long bond yields aren't accurately pricing in the long-term future, and they expect bonds to come down, and as a consequence, they simply keep the cap rate at low levels. Secondly, about a third of the properties are actually revalued on an annual basis. So there's quite a lag that exists within the properties being valued in any case. And then additionally, they also have quite a bit of leeway in terms of whether they believe the current earning stream is the accurate earning stream, or there will be more rosy outcomes going forward. So all of this combines, in our mind, for properties currently being stated on the balance sheet of some of these counters being significantly overvalued. And this we can illustrate within the next chart. So if we were to actually use what we believe to be an appropriate cap rate for these counters, then we see the value of the properties need to come down. And correspondingly, the debt that exists against these properties, the loan to value actually increases quite significantly. So if any of the listed players tell you that their SA properties are conservatively geared, in many instances, we would take the opposite view. So you can see the line there stating the cap rate used by an Equitas, Growthpoint, Hyprop, and a Redefine for their SA-specific businesses. And we believe that these numbers would need to increase over time to more accurately reflect where we are in the cycle and the risks being faced by these specific divisions that exist within the businesses, but also South Africa overall. And then the question, of course, becomes, why are we interested in Nepi Rockcastle? So despite of all these top-down concerns that exist, we actually like NEPI. So in terms of the rising cap rates, NEPI is actually one of the very few companies where we believe the book value that's reported understates the actual value of the underlying properties. Additionally, they've got conservative gearing, which is very well structured, both in terms of fixing the debt and not being impacted in the short time by rising rates, and having a fairly long maturity for the debt profile, which protects the income stream as well. And then in terms of rental reversions, they operate dominant malls where there's still very high demand from the underlying tenants and where the health of the tenants are still good. So every time they renew a lease, they're able to do that at a more attractive rate than the one coming to an end. And then in terms of escalating cost, we spoke a little bit about inflation being rampant, specifically in the European regions. But the triple net leases that NEPI sign with their tenants allows them to pass on the majority of these inflationary increases being seen on an operating basis. So all of this combines to both protect the income stream, which we believe will be growing over time. And then importantly, when you look at the distributable income from the property players, we are very cautious on most of them. And there's quite a lot of detail that goes into calculating what we believe to be the real income stream. And in the case of NEPI, it's consistently been clean, where cash earnings are actually higher than the distributable income. And that's based on conservative assumptions that they use when determining their income. And then, of course, what makes it attractive as well is it's a hard currency income stream with the leases being euro-based. So any negativity from a rand perspective, we would see the benefits flow through for NEPI as South African holders. And we thought this is an interesting chart just to illustrate how patience meets opportunity. So for a very long time, we only took a cursory view of NEPI. And then when COVID struck, we saw a very broad-based sell-off of all the property companies and all companies overall. And to us, it was then important to do the bottom-up work to identify whether the assets have actually been impaired, whether the demand from the tenants and the consumer for these assets within NEPI are still in place. And we came away with a favorable view and believing that the share price at point of initiation was overly negative as to the prospects of the company going forward. And then later on, again, we saw the war between the Ukraine and Russia break out, and there was significant concerns around any assets being held, especially in Eastern Europe, and then how companies will be able to deal with inflation. And we sent an analyst to do on-the-ground work within both Poland and Romania to meet with all the divisional management and to visit all the key assets that they hold. And again, you come away with confidence that given that 98% of their assets sit within NATO countries and that they do have the dominant positioning and the leases in place to deal with inflation, that they'll do well going forward, and the market is again being overly negative on the counter. So there were two instances where we were able to create value for shareholders by doing the hard work. And this is a fortunate outcome. Actually, I would argue maybe in 50% of the cases we do the hard work and either we find there's no opportunity or the share price runs away from us. So this has done well for our investors, and it's a nice chart to show why. But then, of course, the question becomes what next? Is there any value left that still exists? And on an absolute basis, we would argue yes. So in euros, it still offers a forward dividend yield of 10.5%, which is a very attractive rate, especially when you compare their earnings base versus some of the other local listed players. And then we believe this 10.5 will grow over time. But if you look at it on a relative basis, we can see with the move in 10-year euro bonds that have ticked up meaningfully in recent times, that the spread is actually still very much in line to where it has been over the long term of the holding. So on absolute basis, we still think it's fairly attractive. On a relative basis, there's some value to be had, but not as much as one would think. And with that, I'll hand over back to Linda for some Q&A.
And we've had quite a few questions actually coming through, so thank you to everyone who has been submitting those. The first I'm going to ask is from David, and I think this is quite relevant. I'm going to put this to you, Nancy. It asks, what could be a catalyst for a re-rating of the South African market? And I think that's important because whilst you might have undervalued investments, you obviously needed some time for that value to unlock. So what do we sort of see as potential catalysts that could cause a re-rating of the market?
Yeah, I think that's a very good question. I think there's a few, and it could probably be summarized as, anything that really gets growth back into our economy. And for me, a very important aspect of that would be positive political change in South Africa, positive political policies that really drive that growth. Those are very important things. One thing we haven't spoken about, we've spoken about electoral support, but I probably didn't mention in the presentation that 70% of eligible voters in the local government elections didn't vote. So there's a really untapped votership in South Africa that's voice is not being heard. And, that could actually produce a lot of change in South Africa going forward. I think that's it's just important to be cognizant of that fact. And the other thing I would say is that another thing that could cause a re-rating actually is something that's external to South Africa, and that could also be lower interest rates. So a Fed pivot certainly would drive down interest rates globally, would drive down interest rates locally as well, and that could actually also increase our rating on our local stock market.
So Nancy, I'm going to actually keep you on the hot spot because it's a nice follow-up question to you talking about a Fed pivot. Now, a Fed pivot, if we saw rates being cut quite aggressively in the US, it would probably mean that the economy was coming under a bit of strain relative to the resilience that we've seen there. Jesselyn actually asked, what is the probability of a hard landing for the US economy? And of course, we've seen such a shift in expectations around that hard landing, moving more now to, a larger portion of the market expecting a soft landing. So, at this point in the cycle, what do we think the probability is that there will still be some kind of a hard landing in the US, which would see, dramatic rate cuts from this point?
Yeah, I think it's a very, very good question. And I think as we've shown in our presentation, the US is not our preferred exposure at this point anyway, whether we get a hard landing or soft landing. So I do want to mention that. But I think part of that depends on how persistent the inflation is going to be in the US. So we've seen initially that inflation is starting to soften, but we're not seeing convincing evidence that the wage inflation is starting to soften. So do we then see a resurgence of inflation, once the base effects have sort of worked through? Or do we actually see the Fed having to really keep rates higher for longer or hike again, start to kind of stabilize rates and then hike again to actually really get that inflation situation under control? That, I think, is a big question. Another aspect to think about is, why have we not seen a hard landing this time? And with, extreme increases in rates that we've seen, very, very quick rate cycle from the Fed. And there's two primary reasons for that. The one primary reason would be that most mortgages in the US now are fixed rate mortgages. So 90% of mortgages in the United States are fixed rate. So everybody in the US is still paying mortgage rates based on their pre-hiking cycle rate. So very little of that impact, the transmission mechanism of the Fed hiking rates, has actually been buffered by those fixed rate mortgages. And on top of that, the cash balances that we've seen in the consumer in the US are still elevated and only slowly working through. And those were all the fiscal stimulus checks that the consumer actually got into COVID. So I think until we start seeing repricing of a lot of that mortgage book, and until we start seeing those cash balances working through, we're going to continue to see what most of the macro voices are calling this kind of immaculate disinflation, right? Soft landing, slowly lowering inflation rates. But I would just be cautious in that it's not impossible that eventually comes to an end when all of these kind of buffers have been worked through.
Now we're going to shift gears a little bit more and move it a little bit more locally. Vim, I'm going to put this to you. Dale has asked us, what do we think the impact of the NHI will be on the healthcare sector? And of course, we do have some exposure in the healthcare sector, so we do think about these things. Perhaps you could share our views on that.
Yeah. So in the short term, we think the impact will actually be fairly muted. There's not... any real impact will be long dated, and there's still a lot of uncertainty that exists both in how NHI will be funded and what the final form will look like. In the short term, unfortunately, any uncertainty for investors mean that both asset managers prefer to stay on the sidelines, and the people that actually deploy capital within the healthcare space stay on the sideline as well. So we could well see a pullback from a risk perspective. There's various outcomes to it, but, which will be based on how it plays out. But potentially we could see more pricing regulation for the hospital groups, which is our preferred exposure at the moment. But on the benefit side, we could actually see an increased number of insured people moving towards the private hospital sector as well. So we could see utilization rates increase for the various hospital players, which would be very positive from an earnings perspective. But overall, I would say it remains uncertain. The uncertainty is reflected in the share prices, where we do believe value exists within some of the hospital plays. We're happy to wait. So taking a longer term view in this instance, we think will be beneficial to our shareholders.
Right, now we've got a comment through from Gerard. He says, I'm still interested in gold because somehow it feels like the US Fed is never going to raise rates as aggressively as they probably should. So negative real rates might prevail out of the US, and would this not be good for gold? And I'm going to ask you to answer that, Nancy. We have actually introduced a position, a small gold position, into our local equity portfolio, which I think is very interesting. Perhaps you could share your views on why we've done that.
Yeah, sure. Gold is just such a notoriously difficult asset class to call. It does tend to perform well when real rates are lower, and so I would say that that's true. However, it doesn't always, and if you go back and look through the history, it does have a level of unpredictability to it. I mean, why we like gold is that in drawdowns, in terms of other financial assets, it tends to not be correlated in those drawdown events. And so it does live up to its safe haven status most of the time. And that's certainly attractive from our perspective. And also as an inflation hedge, inflation, I would say prior to COVID, everybody was living in a very benign inflationary environment. But we've now really discovered, inflation has come back. It's unclear about how long we will see this higher inflationary environment, but certainly gold is an inflation hedge in that scenario, and that's a very attractive attribute to us.
And a bit of a hedge against geopolitical uncertainty as well, which, of course, we're seeing a rise of that in the global arena as well. Turning to a little bit more, another kind of, sort of quite open-ended question, Vim. Jess asks us, what is the future of AI, artificial intelligence, in finance? Now, I don't know, Jess, if you're asking that because you're in the finance industry, but it is something that we obviously do have to think about very hard to, as Nancy pointed out, to understand what the winners and losers will be over the long term. But what are your thoughts on that anyway, AI and finance?
Yeah, so a very broad question. The problem with any exponential growth, it becomes very hard to forecast, both the outcome and the timeline for things happening. So traditionally, we've seen new technologies being more disruptive than one would have initially thought, but it actually takes longer. If we were to take the very elementary portions of these new technologies, which would have been machine learning, they are very good at doing repetitive jobs that humans used to do in the past. So there they've started to encroach on jobs held by humans. And now we're seeing the artificial intelligence, which is very good at analyzing large data sets incredibly quickly and accurately. And increasingly, they are becoming good at interpreting the data sets. So from writing risk for insurance towards making loans for banks, it's conceivable that within time they will start to encroach on jobs held by humans today within these various segments as well. So if today you were to ask ChatGPT what does interest rates look like in 2025, it doesn't even know how to answer you. So for any small data sets that take assumptions into account about how things will play out going forward, we as humans seem to still have an edge over artificial intelligence, which means I may still have a job for the next few years. But who knows what the limits will be and how long it will take. I think over the next 10 years, we'll see jobs within the financial services sector increasingly shift towards where artificial intelligence are able to do a better job. But then again, new jobs will be created, which it's difficult to fathom today where humans will step in. But we tend to find a way to make ourselves valuable to society. And it may happen there may be some volatility to it, but I think there's a fair degree of confidence that that will be the case here today. So you can probably say less jobs within financial services, but that also means that the cost of providing the service to society comes down. So there may be a race towards doing a better job at a lower cost among the financial services, but the net beneficiary will be society as a whole. And then the real difficult thing to think about is what disruptive companies may come along over time that doesn't have the institutional legacy of having a bunch of humans writing risk for them. So it's very difficult. We think in the medium term, it's likely to be less than what the market believes, but over the longer term, it's difficult to know.
So we also have a question from Frank, which asks us to discuss the economic moat of a company in our top 10 holdings. And I'm going to ask you to answer that, Nancy, if you can think of something we've not spoken about today, where they have an economic moat or a barrier to entry, which will protect their returns on capital over time.
Yeah, I think that, the one that actually immediately jumps to mind, which is a very dominant company in their sector, is actually Eedes. And that is a business which is actually, it's a remarkable business, and it has two main parts to its business. The first part is that it manufactures tiles, and it is almost the only tile manufacturer in South Africa. Actually, I think that there's a very, very small competitor. And the other part of its business is it retails the tiles. It's got three main brands, which would be Eedes Tiles, CTM, and Top T. And actually, amongst those three brands, they're 50% of the retail tile market in South Africa. So they're vertically integrated, they're the only real manufacturer, and they've got 50% of the retail operations. And that really just puts them in an incredibly advantageous position from a competitive perspective. They've been extremely innovative in adding to their manufacturing capacity, so increasingly competing with the imported tiles and doing that very cost efficiently. And yeah, it would be very difficult. I think it's a good example. It's very difficult for new entrants into that market or independents to actually really compete with that level of scale and innovation. And I think that's really one of the many reasons that we like the business.
And then lastly, Wim, no discussion on South African investments is complete without a discussion on the Rand. We've had quite a few questions coming in asking for our view on the Rand. And of course, we are investing for the future, so we do need to take a view on the long-term direction of the Rand. So would you like to share sort of our views and how we think about that? Obviously, a lot of volatility over the year to date. How do we think about factoring in the Rand over the long term into our investment decisions?
Yeah, so in the short term, we are very likely to see continued volatility, and we potentially at an inflection point from a political standpoint, which could see various outcomes to it. You can put a probability of the various outcomes, but we think volatility going into 2024 will remain high. However, if you look at the longer-term prospects for the Rand, the fiscal position of South Africa remains under pressure, and you either need to have more consolidation or you need to have better GDP growth. And we think the probability of a deteriorating fiscal position for SA over the longer term is fairly high. And unfortunately, with that, you will see a weakening of the Rand. So we do position our funds for various outcomes, and we are not binary in thinking about these things, and we try to position the funds so that the outcome for our investors will be decent under a wide range of circumstances. But very much we do take the view that longer term we are likely to see the SA Rand weaker, even where we are today.
So unfortunately, those are all the questions that we have time for today. Thank you, Wim and Nancy, for a very interesting discussion, and thank you to everyone who actually posted questions to us before the session and also live today. I'm just going to quickly summarize what we've spoken about today before we end. Nancy, first of all, noted some concerns about the sustainability of the latest rally in the US, and it has some characteristics of a typical bear market, particularly if you consider the breadth and the fact that it was driven almost entirely by a re-rating rather than improving underlying fundamentals. She spoke about how much of the hype has been around the AI revolution, and that this is a long-dated and uncertain investment case. So it's very difficult to understand at this point fully who the winners and the losers will be. So not dissimilar in that way to the dot-com bubble. She showed how the US labor market has never been hotter, and in effect that means there is still downside risk, both obviously to the labor market and in turn also to US earnings. She then shifted to talk about China in comparison to the US, where they still have plenty of room to stimulate their economy, and how the combination of better priced opportunities with superior earnings growth means we still tend to have a favor towards Chinese equities over most US equities. Turning to the local situation, South Africa incorporated stocks do look cheap, but as we know all too well, there are very good reasons for that. 15 years of stagnant growth, a rising risk of a sovereign debt crisis, and political uncertainty as we head into the elections of 2024. So we always continue to think carefully about risk management. She also noted that some of the offshore counters in the JSE are high in their earnings cycle, so it's not a foregone conclusion that you can just invest in Rand hedge stocks and you're fine. And resources in particular still have further downside to their earnings from this point in the cycle. So our response to all of this is to construct portfolios that still have a material underweight to the resources sector, highly selective exposure to both Rand hedges, multinational businesses with revenues derived from outside of South Africa, as well as to very selective South Africa incorporated stocks, some of which we've spoken about today. And we do still maintain quite a high cash balance in our equity portfolios to take advantage of some of the opportunities that arise when we have volatility. Wim walked us through two examples of our bottom-up investment ideas, which are finding their way into our local portfolios, to give you a sense of how we think about this and how we go about that. He used First Rand as an example of a bread and butter quality business and outlined the reasons why we believe that it continues to be a quality company with good management and the ability to deploy capital at very attractive returns. He then also took us through a very esoteric example, Nepi Rock Castle, and what was particularly interesting about this is that it shows that we don't rigidly stick to our top-down view of the asset class. We are always looking for interesting, attractive bottom-up investment opportunities to populate our portfolios with as many diverse opportunities as possible. And he outlined the reasons for our caution on the property sector and the reasons why we think Nepi Rock Castle is a business that bucks the trend. Ultimately, the two ideas are very different, but they do share some similarities in terms of their characteristics. So this should hopefully give you a good idea of what we look for in businesses that we hold. They both have good management, they're good companies with good positions in their markets, and importantly, they're both attractively priced relative to their underlying fundamentals now and going forwards. That's it for today. A survey will pop up when you end the session. Please do fill it out for us and give us some ideas as to how we can better improve these sessions for you. And please also give us some ideas about what you'd like us to cover in our next webinar. So thank you very much for joining us today. And thank you, Wim and Nancy, for your contribution to today's discussions.
Thank you very much.
Thank you so much.
Wonderful.
Goodbye.